Hi guys, welcome back to Thursday Top Lessons. With the economic crisis looming, I thought it would be a good idea to understand and demystify the Reserve Bank of India and understand how central banks actually work. So, who moved my interest rate? Written by D. Subbarao, the 22nd governor of the Reserve Bank of India. He was an ex-IAS and eventually headed the Reserve Bank of India from 2008 to 2013. My thought behind reading this one was to gain an understanding on monetary policy and basics of practical economics. So here it goes. So first things first, what is money? Money by definition is a unit of account, a medium of exchange and store of wealth. What does the RBI governor do? In words of Raghuram Rajan, his successor, he says that the governor is the primary manager of macroeconomic risk in the country. And what is the basic macroeconomic risk that we're talking about? It's inflation. So let us understand what inflation is. The government's decision to spend on building infra and capital, which is the supply side, and the consumption, which is the demand side, is what determines the inflation. As the pool of money to be borrowed is limited, private sector mostly borrows to invest in the supply side. Now inflation is a regressive tax. The poorer you are, the more you are hit by rising prices. So technically we live in a society of double taxation system, inflation and income tax. In a country like India, inflation is more due to supply side shocks rather than demand side pressures. To deal with anything in life, you need data. Here's something that D. Subbarao says about the quality of data available in India. He says, everywhere in the world, the future is uncertain, whereas in India, even the past is uncertain. And so is the case with a lot of businesses. In my understanding, the first challenge is to get data, and the second challenge is to get correct data. Now let us understand the role of the government. The RBI Act states that the government may give directions to the Reserve Bank where considered necessary in public interest, but only after consultation with the governor. The government must set the goal for the RBI, taking away its independence of goal setting, but grant full independence to achieve that. So it's like the tools given to the RBI are fully autonomous. It is full autonomy with responsibility. But Raghuram Rajan was the last governor to set the monetary policy independently because government nominated appointees to the Monetary Policy Committee soon after he left office. So the general relationship between the government and the central bank, which is the RBI, is defined as follows. It is growth versus inflation, government versus the RBI, the fiscal policy versus the monetary policy. A key challenge to note here is that the government has a short-term cycle, the election cycle, that pushes them for expeditions, whereas RBI has to remain long-term stability. Now let's talk about the Indian economics. The governor's promise that you see on the note, it is a trust that the bearer can exchange the currency note for an equal amount of gold or silver. But this trust ensures that currency notes can be used for transactions without the bearer thinking of exchanging it for precious metal. But nowadays, it is not a gold-backed currency now. After the Bretton Woods Agreement de-linked gold to the dollar price, it is called a fiat currency that is printed solely from government decree. Now it is a mix of gold bullion, domestic and foreign securities held by the central bank. With this fiat currency in place, the amount of Forex Reserves is a common question for any governor. If it is believed to be sufficient, the Forex Reserves, people draw inferences that the RBI will now not intervene in the market and thus it increases appreciation pressures on the currency. If it is believed to be insufficient, inferences are drawn about volatility and the ability of RBI to defend the exchange rate, thereby pulling it down. Both of these things are not good for trade. To quote an example of this, in 1980 for India, the amount of forex was about 3 months of import cover. It was because trade flows dominated the balance of payments and determined exchange rates. Today, global capital flows are several multiples of trade flows. Exchange rates are more a function of capital account of balance of payment rather than the current account of trade. Let's now understand the role of NBFCs in the Indian context. He says their role is important since they plug the gaps left by the banks. But they must also be controlled, as banks literally transfer their risky assets to these shadow banks, thereby freeing up space for themselves for further lending, which leads to an unsustainable debt buildup and a near total implosion of global financial system. During his tenure, he also worked towards the loan to value ratio, which is the LTV for NBFCs, to regulate gold as the collateral for loans to prevent the Indian version of subprime crisis. In the next section, let's talk about exchange rates. When the current account deficit or the CAD is high, the exchange rate correction is inevitable due to the structural imbalances, as the money in circulation is limited overall. As imports rise, lower capital remains to invest in the investing opportunities in that country, thereby weakening your currency. Now, all of us have witnessed a term called currency wars in the recent times due to the US China debacle. It is a situation when countries competitively depreciate their currencies against those of their trading partners in order to cost exports and restrain their imports. They are ultimately self-defeating, as they depress trade and raise the cost of overall trading partners involved. So why is still dollar the sole reserve country of the world? Why, even after US being the epicenter of the 2008 financial crisis, the dollar actually appreciated? See, dollar investors around the world, they began withdrawing their investments, thus pushing up dollar exchange rate. This resulted in dollar shortage outside, threatening the smooth functioning of global payment systems. The Fed, which is the central bank of the US, also provided bilateral swap arrangements to select group of countries which directly impacted the US. Euro was pitted as the alternative currency, but their own sovereign debt crisis is what killed that project. Now, yuan is the second largest currency in international trade and finance. Funnily, the yuan denominated bonds are called dim sum. Yes. Now, dollar enjoys this privilege also because America is running a consistent trade deficit, thereby maintaining enough liquidity of the dollar. As last I know, the current trade deficit of US was somewhere about $600 billion. This is known as the Triffin paradox. Google it. Now, what are the challenges to yuan becoming the currency of the world? See, primarily three challenges. Exchange rate has to be freely determined, which is a little dicey in the case of China. Yuan should become freely convertible in global capital accounts. Also, the yuan misses out on the third definition of money, which is it should act as a store of wealth. Currently, it does not. So this book is like the economics 101 course for the beginners out there. Later, we'll try and cover his successor's book, I Do What I Do by Raghuram Rajan, and detail out more instances and nuances of the central bank, which is Reserve Bank of India.